Welcome to Capital Allocation Lab.
Our mission here is clear: to deliver calm, long-term lessons for fundamentals-minded investors. We revisit classic ideas, often those overlooked in the current market noise, and translate them directly into actionable judgment tools for owners today.
If your focus is on building wealth quietly, consistently, and with a robust margin of safety, then please subscribe and like to support more educational episodes like this one.
Today, we are undertaking one of the most critical lessons, really, in financial history, derived from Chapter 17 of The Intelligent Investor. It's called 4 Extremely Instructive Case Histories.
Extremely instructive, right?
And we're focusing on extremes in corporate behavior and, crucially, balance sheet fragility.
We're not looking at averages today. We're looking at outright catastrophes.
Yep.
Our historical guide will be 4 specific examples. The shocking railroad collapse of Penn Central.
A giant.
Yeah, then the debt-fueled industrial sprawl of Ling Temco Vought, or LTV.
The conglomerate era epitomized.
Then there's the audacious minnow swallows the whale story of NVF and Sharon Steel.
Incredible financing on that one.
And finally, AAA Enterprises, which sort of demonstrated the fatal flaw of writing a singular magic word to market oblivion.
And we won't leave these lessons stuck back in the 1970s. We'll show you how the exact same signals reappeared really quite loudly in the 1990s and 2000s. Think cases like Lucent, Tyco, AOL, Time Warner,
Oh, yeah.
and that dot-com clash of eToys versus Toys R Us.
The ultimate goal here is to provide you with a simple, forward-looking field manual. We want to give you the judgment tools needed to spot these danger zones, those early warning signs, long before the company hits the covenant wall and the financial headlines start screaming.
Ready. Let's unpack these historical patterns and translate them into robust, forward-looking habits.
Graham opens this section with a profoundly simple, yet often ignored observation. History isn't smooth. Markets don't follow some tidy upward trend. They swing violently to extremes. Extremes of public enthusiasm, extremes of available credit, and dangerously extremes of accounting optimism. So if you focus only on averages, on median statistics, you completely miss the structural instability that is, well, pretty much guaranteed to destroy capital when the cycle turns.
Exactly. Case histories are so invaluable because they are like live footage of what happens when financial structures are pushed past their breaking point. When we analyze these 4 failures, you see the same recurring signals pop up again and again.
They're quite.
Things like debt that requires razor-thin interest coverage, cash taxes that magically vanish for years on end, swelling goodwill from endless M&A, the sheer financial burden of serial acquisitions, and critically, market prices that detach entirely from the underlying business reality.
Oh.
When enough of those specific yellow flags cluster together, the catastrophic outcome is frankly predictable.
So before we jump into the first case, let's establish what you call a 5-minute triage. This is a set of blunt, quick rules you can apply to any company with meaningful debt. And bluntness here is actually a massive advantage.
It really is.
Because it saves you from being seduced by some compelling growth narrative that's actually financially fragile underneath.
Agreed. Check number 1 is coverage. This is the fixed charge test, and it's probably the most important one. You have to compute interest coverage the most conservative way possible. Operating income before taxes divided by the interest expense.
Okay.
And Graham established a minimum safety standard for conservative bondholders and equity investors of 5 times coverage.
Yeah.
5x.
Now, hold on. 5 times coverage sounds incredibly conservative, especially thinking about the low-rate environment we saw for, well, much of the last decade.
Yeah.
Doesn't a tech company maybe need less safety cushion than an old capital-intensive railroad like Penn Central?
That's an excellent challenge, and it really gets to the heart of the discipline required here. While, yes, the required coverage ratio might be slightly lower for certain asset-light businesses, the standard remains crucial, especially for cyclical or capital-intensive firms. Remember, 5x is the safety net through a normal economic cycle, not just when things are great at the peak. When a recession hits, even a mild operating income is often the first thing to decline, sometimes sharply.
Yeah, makes sense.
So if your starting coverage is already under 3 times, let's say 3x, you are firmly in the danger zone. The margin of safety is just. It's not there. We insist on the 5x rule as the ideal target because it offers real protection against the inevitable fluctuation of operating income.
That reframes it perfectly. It's not just about what they can afford today, but what they can survive tomorrow.
Precisely. Okay, check number 2, cash taxes. This is a potent early warning signal that so many investors overlook because they only focus on the reported net income line.
Right, the bottom line number.
Exactly. If a company reports healthy GAAP profits on paper, but has paid little or zero cash taxes for years, you must investigate immediately. A long drought in cash taxes suggests the reported profits aren't durable, or they're largely non-cash accounting phenomena, things like tax assets, deferred liabilities, or maybe aggressive accelerated depreciation.
Stuff that doesn't translate into real taxable economic activity.
Exactly. It's a classic mismatch between accounting reality and cash reality.
Okay, check number 3. Addresses receivables and inventory versus sales. This points to working capital stress.
Absolutely.
So if your accounts receivable are rising much faster than your reported revenue, your customers are taking longer and longer to pay. The sale is on paper, but the cash hasn't actually arrived.
Right.
And if inventories are ballooning alongside this, the product isn't selling efficiently. That combination is a huge danger sign, especially when management is simultaneously talking up record sales and focusing only on the top line.
That's a classic setup. Check 4 focuses on goodwill and adjusted earnings. In periods of high M&A activity, like we've seen periodically, goodwill swells on the balance sheet. This goodwill represents the premium paid above the tangible value of the acquired company.
It's an intangible asset.
It is, and it requires sustained, high-quality, growing cash returns to justify its existence on the balance sheet. The danger zone is when goodwill swells, but the actual GAAP earnings, the fundamental reported profit, starts to sag. This forces management to rely heavily on adjusted earnings, which typically strip out things like amortization of intangibles, restructuring costs, maybe stock compensation, simply to tell a rosy financial story that the GAAP numbers just won't support anymore.
And finally, check 5. Price versus proof. This is the trap that catches investors in pretty much every boom cycle. A compelling story, maybe a charismatic leader, a tiny business, and a towering market value is never an investment thesis.
No.
It is strictly a reading of crowd psychology and, frankly, promotional success. You had to demand hard evidence, measurable free cash returns, proving unit economics, and demonstrably defensible competitive moats.
You really do.
If the only justification for the current stock price relies on vague, unquantifiable terms like brand, category leadership, or that ever-elusive promise of synergy, you need to pause and step back.
We're going to apply that 5-minute triage checklist now, starting with probably the most massive collapse of its time, Penn Central.
Penn Central was an absolute behemoth. I mean, the largest railroad in the United States, formed in 1968 by merging the Pennsylvania and New York Central systems. It felt like an institution, yet it filed for bankruptcy just 2 years later in 1970. Shocking.
The signals were blaring for years before the collapse, though, particularly if you followed that fixed charge test we just talked about. On a report basis, their interest coverage was only around 2 times.
Wow, only 2x.
Yeah, catastrophically below the 5x safety standard. A heavy railroad is capital intensive, it's cyclical, it's highly exposed to economic fluctuations, meaning it desperately needs that 5x cushion. They had less than half of it.
So what made the financials look temporarily healthier than they actually were? You mentioned this tax mirage. Can you explain the mechanics of how a seemingly profitable company avoids paying taxes for so long and why that should raise such a giant red flag?
Absolutely. The railroads, partly due to historic investments in regulation, used highly accelerated depreciation schedules and had significant tax loss carryforwards. This meant their depreciation expense for tax purposes was much higher than their depreciation expense for reported GAAP purposes.
Okay.
The result, their taxable income was minimal or zero, while their reported net income looked positive. This artificial inflation of net earnings, by not needing to set aside cash for the government, was a massive boost to their reported results.
But it wasn't real cash profit supporting the debt.
Exactly. When you plugged in a realistic, sustainable corporate tax rate into their reported operating income, the interest coverage just collapsed to a level that signaled almost certain failure down the road. The signal is simple. No tax bill signals an accounting mismatch with economic reality.
So the investor's reflex should be simple. If they aren't paying the tax man consistently over time, the reported profit is almost certainly illusory or at least not replicable.
Precisely. And the price illusion is key here too. The stock was still trading in the teens shortly before the actual bankruptcy filing.
Incredible.
The market was ignoring the structural fragility, pricing the stock based on hope and habit, right until the company literally ran out of liquidity and hit a legal covenant wall.
So the lesson translates into a clear, actionable move Graham suggested for bond investors at the time. Just swap for quality.
Right. Conservative investors could have sold the Penn Central 4.5s due 1994 and simply swapped into the Pennsylvania Electric 4Us due 1994. Similar yield, vastly superior safety and coverage.
The lesson remains timeless then. Quality is the only protection when facing a downturn, and that quality starts with the cash ability to pay fixed charges, period.
Okay, LTV. This is the classic case study of the 1960s conglomerate built purely on debt and euphoria. Under James Ling, the strategy was aggressive serial acquisition, using maximum leverage to roll up totally unrelated businesses. Their sales exploded from millions to billions in just a frantic rush.
Wild growth.
They added nearly $400 million in bank debt, even when their existing coverage was already stressed.
Which begs the question again, why did the sophisticated bank lenders, and the market for that matter, enable this kind of reckless growth?
Because in a boom, empire building looks safe and exciting. The acquirers report record earnings, often boosted by accounting tricks, and the market just rewards growth at any cost. But LTV was a masterclass in making the present look perpetually brighter than it really was through creative accounting. They heavily utilized something called pooling of interests.
Yes. For our listeners, can you quickly elaborate on why pooling of interests was such a, destructive financial tactic back then?
Sure. Before the accounting rules changed, pooling allowed two companies to merge their balance sheets as if they'd always been one single entity. Crucially, this method allowed them to avoid recognizing the purchase price premium, the Goodwill, which meant the acquirer didn't have to show the massive cost of the acquisition on the books. This immediately flattered the resulting earnings because they didn't have to face the depreciation or amortization costs associated with the true purchase price they paid.
Got it.
They also used low depreciation rates and capitalized costs that really should have been expensed. This created an illusion of rapid, profitable growth that the underlying cash flows simply could not sustain.
So the resulting structure was just a house of cards, massive debt, nearly $2 billion, totally inadequate coverage, a thin current ratio, and equity that was mostly just a sliver of paper value derived from that goodwill.
Exactly. The machine was basically designed to seize up the moment the economy slowed down.
And it did, predictably.
And it did. For today's investor tracking a serial acquirer, you need some internal controls. First, track free cash flow per share, excluding acquisition spending. If the existing business isn't compounding organically on its own, the whole strategy is just a treadmill burning cash.
Right.
Second, look closely at the ratio of goodwill to tangible capital. If the equity base is mostly goodwill, there's very little tangible buffer against an economic downturn or a necessary write-down. Third, and this is critical, tally up the so-called restructuring costs over several years. If a new definition of non-recurring charge seems to appear annually, well, the only recurring thing is the accounting adjustment used to reset the earnings baseline.
Right.
The final owner's question here is non-negotiable. If this business stopped buying other businesses next year, would the returns on the capital already employed be attractive? If not, you are funding a corporate promotional machine, not buying a real earning asset. This case, NVF and Sharon Steel, it's famous for its sheer audacity. NVF, a small manufacturer of vulcanized fiber, somehow managed to acquire Sharon Steel, a company roughly 7 times its own size. This is where financial engineering meets reality with a spectacular crash. The fragile financing was the screaming warning sign from the start. NVF used junior bonds and warrants to execute this massive deal, basically layering high-risk debt onto an already thin capital base. The crucial detail is that the buyer's own existing junior debt was trading below 40 cents on the dollar, even as they launched the takeover.
Wow.
If the market is telling you your existing paper is basically distressed, leveraging up 7-fold is just suicidal.
And the accounting manipulation followed immediately, right? How did they prop up the reported earnings to make this fragile structure look viable, even just temporarily?
By adjusting 2 key assumptions that conveniently affect non-cash expenses. First, they adjusted pension assumptions, specifically raising the expected return on pension plan assets.
Which lowers the stated annual pension expense on the income statement.
Exactly. Lowers the expense, boosts the profit. Second, they lowered depreciation rates on their now massive asset base from Sharon Steel. These adjustments combined added roughly $1 per share to reported earnings.
Paper profit.
Purely paper profits designed to meet market expectations and keep the facade up, but they did absolutely nothing to improve the actual cash reality or the dangerously thin interest coverage.
The principle seems crystal clear then. when a small company uses junior paper high-risk debt and warrants to finance a large takeover while its own existing debt is already trading at distressed levels, you are watching a financial time bomb tick down. The complexity, like those strange employee stock purchase plans involving installment-paid warrants, often just serves to obscure the fundamental weakness.
Today's rule is simple. When evaluating any transformational acquisition, strip away the rosy synergy promises and calculate the brutal truth. What is the realistic post-deal interest coverage? What is the ratio of net debt to realistic free cash flow over a full economic cycle? If that resulting coverage ratio is skinny, you have to pass. Bravado is never an adequate capital cushion.
AAA Enterprises provides the quickest, sharpest lesson in promotional hype versus actual business substance. This small firm rode the magic word of the 1960s franchising to an inflated IPO price, watched the stock double again in the aftermarket,
Pure momentum.
and then within just 2 years, filed for bankruptcy. Boom, gone.
The failure was total. The business model was completely aimless, wandering into unrelated areas like carpet stores and mobile homes. Reported profits vanished almost instantly into deep losses, and the shareholders' equity, which largely consisted of the public's massive overpayment in the IPO, simply evaporated.
The seductive element here is always the label, isn't it? Whether it was franchising back then or maybe platform or AI today, the core problem is always that massive gap between the exciting label and the actual measurable unit economics of the business.
This brings us to the ultimate universal test. You have to ask yourself, if the capital markets close for 5 years, could this business fund itself, service its existing debt, and survive based purely on its internal cash flow? If the answer requires constant new capital injections or continuous issuance of stock to new believers, you are underwriting a promotion cycle. You are not buying an earning asset. When market belief inevitably cools, the capital structure, which relies entirely on the stock price, not the underlying profit, collapses, often very rapidly.
It's just remarkable how Graham's patterns are perfectly preserved in amber almost. They didn't die in 1970. They echoed loudly and often with far greater speed and destruction, right through the late 1990s and early 2000s tech bubble and its aftermath.
Lucent was a tech darling spun out of AT&T, right? Yet its financial statements, years before its eventual painful collapse, emitted this low hum of familiar stress. The 4 classic signals were all there.
What were they seeing?
Persistent net losses despite rising sales, a bad sign. Accounts receivable racing ahead of revenue, that classic signal that the company was basically extending credit to customers, maybe questionable credit, just to book the sales.
Channel stuffing, essentially.
Could be. Ballooning goodwill from a string of poorly integrated acquisitions, and capitalized software costs creeping higher and higher, which deferred expenses and flattered current earnings.
And this is the crucial distinction you made earlier. None of these alone necessarily kill a company overnight, but their combination signals that the margin of safety is severely thin. The business is running so close to the financial edge that just one bad contract or one unexpected interest rate hike that tightens credit is enough to trigger disaster.
Exactly. There's no room for error. Tyco, under its controversial leadership back then, was the quintessential serial acquirer of the late 90s. Their financial statements became notorious for being absolutely filled with recurring one-time merger-related charges.
This perfectly illustrates your treadmill test. When a strategy is based on rolling up businesses one after another, you have to constantly track the actual cash spent on the deals against the sustainable cash generated by those deals over time.
We do.
If the reported growth requires endless internal financial resets, and a new category of non-recurring adjustment seems to pop up every single year to clean up the messes from prior deals, it is definitely not a compounding machine. It's a treadmill that's consuming capital faster than it can generate true, sustainable wealth.
It becomes this high-speed game where the only way to avoid the crash is to acquire the next company faster than the market can fully digest the perhaps failure or underperformance of the last one. It's an unsustainable model built entirely on momentum, not on solid unit economics.
The merger of AOL and Time Warner in 2000. It was hailed as the definitive moment of the internet age, the marriage of old and new media. But what truly defined the deal, looking back, was the currency used. Pure euphoria.
Exactly. The smaller, asset-light, profit-thin AOL ended up holding the majority of the equity in the combined entity.
This is the modern echo of the MVF Sharon deal, isn't it? The lesson is that the currency of the deal, in this case AOL's massively inflated stock valuation, temporarily obscured the underlying operating weight and realities.
Absolutely. A minnow used its puffed-up paper currency to buy a whale. but the fundamental economics of integrating a capital-intensive media giant like Time Warner with a consumer internet service proved, well, impossible. When the market valuation inevitably returned to Earth, the paper value created by that initial euphoria just vanished in one of the largest Goodwill write-downs in history.
Valuation matters, even in a so-called merger of equals, or, in this case, a merger of pretty extreme disparity.
The dot-com peak provided perhaps one of the clearest disconnects between story and substance imaginable. eToys, a young online retailer with massive negative income, tiny physical assets, and just a fraction of the sales,
Burning cash like crazy.
carried a larger market capitalization than the established, cash-generative, profitable leader, Toys R Us.
Just madness in retrospect. This crystallizes the core valuation question you have to always ask yourself. What must go right, and for how long, and without any significant competition arising, to justify today's current stock price?
Right. The eToys price required years and years of absolutely perfect execution, no economic downturn whatsoever, and a perpetual stream of cheap capital to fund the losses. The market rarely, if ever, grants that kind of perfection, especially when competition is fierce and the cash burn rate is incredibly high.
The stock market price often reflects the possible, but true value requires assessing the probable. Big difference.
Okay, let's try to translate these past failures into a working, proactive checklist. Think of these as 10 questions to ask before you commit capital. This is your pre-mortem analysis, trying to kill the idea before it kills your portfolio.
All right, number one, coverage. Is reported interest coverage comfortably above that 5 times mark through a normal economic cycle? And you have to test its resilience, assuming a tougher recession than maybe the last one we saw.
Good point. 2. Cash taxes. Are cash taxes paid roughly in line with pre-tax profits over time, not just 1 year? If the tax liability seems permanently low or zero, you need a highly specific, verifiable, and time-bound explanation for why, not just deferred tax assets.
3. Working capital. Are receivables and inventories growing slower than, or at least in lockstep with, revenue? Test the cash conversion cycle. A lengthening cycle almost always signals underlying stress.
4. Goodwill. What percentage of total assets is actually comprised of goodwill or identifiable intangibles? And maybe more importantly, is the organic free cash flow growing robustly enough to justify those rising goodwill balances? Or is it just acquisition accounting?
5. Adjustments. How often is management asking you to ignore GAAP results and focus solely on their preferred adjusted results? Consistent adjustment usually suggests consistent underlying problems they're trying to mask.
6. Acquisition discipline. Can management clearly articulate a repeatable edge in buying and integrating businesses that goes beyond simple multiple arbitrage or just getting bigger for bigger's sake? What's the real skill?
7. Working capital funding. Is there an unhealthy reliance on short-term debt sources like commercial paper or maybe extensive supplier financing programs? Retained cash funding signals true resilience relying on your own operations.
8. Capital structure. Does the mix of debt and equity actually match the business model? Cyclical and capital-intensive firms absolutely require a larger equity cushion to survive the inevitable troughs in their business.
9. Internal funding. Is growth funded primarily from retained operating cash flow at attractive returns, or does it seem to require constant new share issuance or piling on more debt? Where is the growth fuel coming from?
And 10. Price. Have you translated the optimistic future you believe in into tangible, conservative cash flows? And are you demanding a significant margin of safety based on a lower, more conservative estimate of those future flows? Don't pay for the rosiest scenario.
Okay, let's put the rubber to the road with some quick math, using a fictional company X to make the Graham discipline really tangible. Let's assume company X has $2.0 billion in revenue, $300 million in operating income, and $120 million in interest expense. Net debt is sitting at $2.5 billion.
All right, step 1, coverage check. Nice and simple. $300 million in operating income divided by $120 million in interest expense equals 2.5 times.
Straight away fails the Graham 5X rule.
Immediately, the company is financially fragile right out of the gate.
Okay, step 2, free cash flow estimation. We need to get a bit more granular here to understand the actual cash available for debt service and for the owners. Let's assume the company reports $180 million in depreciation on its income statement, but realistically requires $170 million in maintenance capital expenditures, CapEx, just to keep the existing business running, replace worn-out equipment.
Okay, that's a crucial distinction, maintenance CapEx. So starting with $300 million operating income, we add back the non-cash depreciation of $180 million, but then we subtract the necessary cash maintenance capex of $170 million. That gives us about $310 million in FCF before interest and taxes.
Right.
Now we have to deduct the $120 million cash interest expense, leaving $190 million. And after applying a realistic, let's say 25% cash tax rate on that, the estimated free cash flow left for the owners is maybe $140 million to $150 million.
Okay, so $150 million FCF
Hmm.
on $2.5 billion of net debt. That sounds incredibly thin.
It's an incredibly thin owner's yield, yes. It indicates very low protection if anything goes wrong.
All right, step 3, inversion. This is where you force yourself to challenge the current reality, right? What operating income is actually required to meet the 5x coverage standard on that $120 million of interest expense?
Simple math. $120 million interest multiplied by 5 equals $600 million. They need $600 million in operating income to hit the minimum safety standard.
Okay, now ask the painful question. Is the path from the current $300 million operating income to the required $600 million believable without resorting to heroic, non-cyclical assumptions? If the company's operating income has to literally double just to reach the minimum safety standard.
The current position is just financially too fragile. You have to pass. The risk is too high.
Step 4, price warning. Let's say, despite this fragility, the market still values this company's equity at $6 billion.
Right.
Your total enterprise value, that's market cap plus net debt, is $8.5 billion. That valuation demands extreme certainty in a very, very bright future. One where that $600 million operating income target is hit almost immediately and sustained. If the cold math doesn't support that level of optimism, the historical examples are whispering, maybe screaming. You are paying for hope, not proven economic reality. Hashtag 4.3, reading footnotes without getting lost.
The footnotes are, of course, where the complexity often hides and where management discloses necessary information that they perhaps hope you won't connect directly back to the headline numbers on the income statement. You really have to focus on these areas.
Like revenue recognition. Check if the policy's recently changed. Look for signs that sales are being recognized earlier, maybe before cash is fully collected or before all the service obligations are met. This will always tie back to and help explain the swelling accounts receivable check we talked about.
Exactly. Acquisitions note. When reading the breakdown of a purchase price in the M&A footnote, note how much became goodwill versus identifiable intangibles. And watch for that Lucent Tyco pattern. The cash returns from the acquired businesses lag substantially, yet management continually reassures everyone that the required goodwill impairment tests always pass until they don't.
Assume the failure is delayed, not avoided.
That's a safer assumption. Restructuring and special charges footnote. Keep a multi-year tally yourself. If you see the Tyco pattern, a large one-time charge followed by a nice, clean reset earnings base, and then, surprise, another large charge 18 months later, you are likely watching an earnings management cycle designed to smooth results, not truly non-recurring events. And pension and post-retirement assumptions. Note any assumptions management makes that seem overly optimistic compared to peers or reality. For instance, raising the expected return on plan assets assumption artificially lowers the company's stated pension expense for the year, giving a subtle but purely non-cash boost to paper profits. We have to put these individual company failures into the broader context of the macro credit cycle. Credit standards always tighten dramatically after a bust, but they become most generous, almost dangerously loose, right near the peak of a boom.
Right.
The LTV acquisition spree, for example, was fueled by banks competing fiercely for loan volume, often allowing their internal sales culture to override traditional prudence and risk management.
That means, for us as investors, you have to be extra skeptical when credit appears cheap and readily available. Abundant credit can easily mask underlying deterioration in unit economics because even poor businesses can borrow cheaply to paper over their flaws for a while.
Absolutely. The best defense is probably to structure your own portfolio to handle the possibility of rising rates, even if you don't personally forecast them. Financial fragility gets exposed brutally the moment the cost of money goes up. Hashtag 5.2, the right and wrong way to use pro forma.
Pro forma, or adjusted numbers.
Yeah.
They're everywhere now. And sometimes they are necessary, right? If a company takes a legitimate, truly one-time cost, say, shutting down an old manufacturing plant, ignoring that specific cost when calculating ongoing profitability can clarify the run rate economics.
It can be useful, yes, but the track is management constantly pretending recurring costs are somehow non-recurring. We insist on 2 rules here. First, the payback clock. If management promises a restructuring will save, say, $50 million annually, They must attach a specific date by which those savings will be visible as cold, hard cash flow improvement. Hold them accountable. Second, the symmetry rule. If the company conveniently ignores large, non-recurring losses when discussing its performance, they absolutely must also ignore any non-recurring gains when boasting about results. You cannot just cherry-pick the positive adjustments while dismissing the negative ones as one-offs. Hashtag tag 5.3 owner's playbook for acquisitions. Okay, if you own a company that actively engages in acquisitions, like the Ling Temco Vought model, you absolutely must hold management to a very strict playbook.
Makes sense. Rule 1, define the circle. Stick to acquiring businesses you, the management team, can genuinely understand and operate well. This prevents the classic trap of just trophy hunting or empire building for ego.
Crucial. Rule 2, pricing. Price the deal to earn an attractive hurdle rate on cash returns, regardless of what the immediate EPS headline looks like. Don't play the EPS accretion game if the cash economics don't work.
Rule 3, funding. Pay predominantly with cash generated by the existing business. Using massively overvalued stock currency might be tempting in a boom, but as the AOL Time Warner disaster showed, the market usually imposes a painful correction later, punishing the original shareholders.
Rule 4, communication. Management must clearly explain how the acquired cash flows are expected to compound per share for the current owners. Focus relentlessly on cash flow per share growth, not just the total size of the growing empire.
And Rule 5, accountability. Management needs to report on the performance of prior deals using the exact same scorecard and assumptions that were proposed back when they were selling the deal to shareholders. No moving the goalposts later. Hashtag 5.4, translating uncertainty into position size.
Position sizing is really your final control lever against this kind of financial fragility we've been discussing. If you encounter a fundamentally good business that nonetheless carries some yellow flags, like those swelling receivables or maybe aggressive capitalization practices,
Things that make you a bit uneasy.
exactly. Start with a small or maybe a half-weight position in your portfolio. Require the balance sheet and the cash flow statements to actually prove their resilience over several quarters before you commit more capital. Let the company earn a bigger position.
Conversely, you should feel comfortable sizing positions bigger when you see that positive trifecta. Strong interest coverage, conservative accounting practices, and clear evidence of organically funded growth. Financial fragility must always equate to a smaller initial investment size. The margin of safety applies to how you structure your own portfolio, not just the entry price of the stock. Hashtag 5.5 owner's glossary of warning labels.
Let's quickly decode some common management buzzwords that should automatically trigger a deeper investigation or at least healthy skepticism.
Okay, transformational. Translation. This deal is large, highly complex, and therefore inherently risky. Your reflex must be to ask for the pro forma post-deal interest coverage calculation conservatively estimated.
Good one. Unique platform. Translation. We really hope these multiple acquired businesses will somehow share customers or costs, but it's largely unproven. Demand hard cross-sell data and customer churn rates, not just the concept.
Adjusted EBITDA. Translation. We are definitely ignoring real cash costs, usually stock compensation, often recurring restructuring charges, and maybe other things too. Ask how much of that adjusted EBITDA actually converts to real free cash flow after maintenance, capex, and cash taxes are paid. That's the number that matters.
Non-cash charge. Translation. Okay, some past aggressive optimism embedded in our balance sheet is finally being recognized and reversed. You must ask why the prior assumptions were proven wrong. What broke down?
Synergies.
Yeah.
Translation. These are promised cost cuts and maybe some potential revenue growth, but they're notoriously hard to achieve. Demand a dated scorecard for tracking them and a clear plan for cultural integration and customer retention during the messy post-merger period. Hashtag 5.6 temperament and discipline.
You know, the hardest lesson in all four of Graham's original cases is really behavioral. It's not mathematical. For a period, sometimes a long period, the stock price rewarded the believers, the optimists. Insisting on Graham's boring 5x coverage standard and conservative accounting feels, well, it feels dull when your neighbor's apparently making a fortune in the latest speculative craze.
It really does. But your only sustainable compounding edge over the long run is that refusal to compromise safety for the chance to look clever or get rich quick in the short term. Boring in the short run almost always equals solvent in the long run, and solvency is the absolute prerequisite for compounding wealth over decades. All right, time for a quick mailbag focusing on the practical application of these lessons when you're dealing with companies maybe right on the edge.
Okay, Q1. What if a company clearly fails the 5x coverage test, but management presents a credible turnaround plan? Our answer. Treat this situation exactly like a skeptical, distressed debt lender would. Demand a bargain price that fully reflects the high risk of failure. Require a written, concrete turnaround plan with clearly defined, measurable steps. Establish a clear cash runway. How long can they survive if things go wrong? And, crucially, set a specific non-negotiable exit trigger if the plan fails to execute on time. And the position size must be tiny. Hope, as we saw vividly with Penn Central, is never an adequate capital cushion.
Okay, Q2. How do we separate real, sustainable organic growth from promotional growth that just requires constant financial engineering or marketing spend?
Use two simple tests. Test 1, customer cash. Are new customers arriving primarily because older customer cohorts are happy, expanding their usage and being retained easily? Or is it just because marketing spend is continually climbing in a desperate race against high churn? Follow the customer behavior.
Right.
Test 2, cohort economics. Do customers repay their acquisition costs relatively quickly through their purchases, or does the company seem to need constant capital refills just to sustain the marketing engine and acquire the next batch of customers? If the company's disclosures are too thin or opaque to run these basic tests, well, that silence is often the answer you need. It's likely promotional growth.
And a final mindset check for all investors evaluating any company. Can you describe simply and without resorting to slogans or buzzwords exactly how the business earns excess returns on the capital it employs? If your explanation requires vague adjectives like unique or relies heavily on terms like platform, you probably haven't identified the true defensible competitive moat. Specificity always beats a slogan. Hashtag tag 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 6.2 final recap.
So to quickly recap the four most extreme but instructive lessons in capital allocation from Graham, Penn Central taught us never to ignore weak coverage and the loud warning signal of unpaid cash taxes.
LTV showed us that empire building fueled by cheap debt collapses inevitably when the economic bill finally comes due.
Envy of Sharon proved that complex, fragile paper financing and overly optimistic non-cash accounting are guaranteed destroyers of long-term value.
And AAA Enterprises confirmed that writing a magic word or a fleeting fad is never, ever a substitute for a durable, profitable business model with a real competitive moat.
The antidote to all these historical collapses remains exactly the same today. Demand comfortable interest coverage, ruthlessly follow the actual cash flows, deeply discount management optimism and projections, and insist on buying only with a true, verifiable margin of safety embedded in the price you pay.
This channel exists for investors who would rather compound quietly and steadily than chase market noise and fleeting trends.
Thanks for joining. If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.
Drop a comment with a concept you want us to unpack next. Maybe owner's earnings, disciplined buybacks, or perhaps reading adjusted EBITDA even more skeptically.
Until next time, keep your standards high, your pace patient, and your margin of safety wide.